Today, folks, we're going to talk about my investing strategy, the stocks I bought today against the backdrop of an absolute tank that is going on in the markets. I wouldn't say are crashing, but we are in a correctional period, a well-deserved breath after absurd rallies that feel like they went on for weeks. Just call me Jerome Powell, damn it. We be printing like there's no tomorrow. It's got an exuberation to it, right? We've all been way too excited about this, but I didn't want to stop buying stocks. As many of you know, I sit on about $10,000 in emergency cash, not my emergency fund, but my emergency cash in case the market drops by 10% or more. That is when I get a bit more aggressive and I want to double up my monthly cost average contributions. But I recognize that the market was getting exuberant and I told myself, hey, I'm going to start putting a bit more cash aside because I don't trust this. And then I hit myself and I said, no, you are a monthly cost average investor, no matter how high, no matter how low. And I wanted to remove some of the volatility from my portfolio and continue to get some performance. And in moments like this, there seems to be some defensive plays with the lower half, the more dividend-oriented stocks, the lower half of the S&P 500. So what I went ahead and did today is I actually bought some VDY because actually the Canadian markets are doing pretty well today. SCHD is doing pretty well today. And when the market does these big fluctuations because of technology, I actually don't see the same weighted drops because obviously I have 30% of my portfolio in these more defensive plays. That's what I'm calling them. I don't think they're defensive, but they act defensively in a market like this. So what I went ahead and did is I took the combination of all my ETFs, all the stocks I hold, and I said, hey, how do they overlap with the S&P? How much exposure do I really have to the technology? And what I went ahead and did is use the software to actually combine the dollar values across all my holdings within these ETFs to actually tell me what the top weighted holdings were. And we're going to go through them by percentage at the end of this video. But first and foremost, I want to talk about kind of the cyclical nature, right? Because CPI data came out, it's more bullish, it's better. Obviously, it's dropped 1.1% in June, primarily because gas was down. But overall, over 12 months, we're now at 3% for the United States, of course. Once we get back into that 2% range, they're expecting that they could see some interest rate cuts by fall, September, which is what I've been touting. I said we'll probably not see anything until fall, or basically summer or fall. And that's kind of where we're at. Now, the Canadian markets, they've already started cutting interest rates because we're in the 2% inflation area. So we need these interest rate cuts. That's the only thing that's really going to truly, I think, boost the lower half of the S&P. But it's funny that in these hype markets, when people get a little skittish, they start pulling their money out of tech and they start rotating it. I mean, it's clear as day. You can see it on the heat map. I mean, look at this. You got Microsoft down 2%, Apple down 2.4%, Nvidia dropped 4%. I mean, Tesla, obviously, the run we went on was insane. You can't go on a 40% run, 50% run over a month and not see somewhat of a correctional period. But look at Home Depot, oddly up 2%. Not like real estate's doing that much better. You kind of just skim through the lower half of the market. There's a lot of green out there. You look at utilities doing exceptionally well. Almost all the utilities are green. There's just a lot of good going on here, right? So if we take a look at something like SCHD that holds a lot of these lower end stocks, we can see that's actually performing pretty well. I mean, nothing compared to the S&P, and I'm not holding this to get S&P like performance. It's more for dividend oriented income, but I like seeing that it removes the volatility on days like this. Like, I'm not going to see the same drop you are if you're just purely S&P and QQQs, right? And we can see the top holdings in here are companies like Home Depot, Amgen, you get some healthcare, AbbVie, Cisco Systems, Chevron, a little bit of oil. It's doing surprisingly well, Verizon. And these are the kind of stocks that I actually like having exposure to. It's a great way to diversify as passively as humanly possible because I don't have to manage these dividend stocks, right? So let's look at the TSX. Same deal. The TSX doesn't have a lot of technology in it, and it is doing exceptionally well today. Obviously, not everything's doing well, but you look at tech, right? And tech is getting hit here, even in Canada, while the rest of the market is starting to do pretty good. Not as good as the US, but Canada never does as good as the US, let's be real. But that's giving a VDY a bit of a boost today. VDY is up 3.7%. Heck, if I get that 4% yield, that's like 4.5%, 5% yield off this ETF over the year, hey, I made market average returns. I've made like 9% this year. That's really not that bad. 8 or 9% is what it looks like. That might be where we're heading with this. So I love these kind of stocks because they're my favorite. It's Royal Bank, TD, Canadian Natural Resources, Enbridge, Bank of Montreal, Nova Scotia, Suncor, Manulife. Like, how do you go wrong with these kind of stocks? Now, a lot of people have been beating themselves up because obviously I wouldn't be 100% dividend oriented investing in a market like this because I still think technology is the future. Hell, it's why Tesla is of my largest position in my portfolio. And let's talk about that, right? So again, this is the totality of all my stocks and how they overlap in each one of my ETFs. And I find this very interesting because obviously Tesla's the biggest position as it stands. Now, this is an A1 for one. I just kind of punched the numbers in real quick. So Tesla should be a bit bigger in the totality of my portfolio than 10%, even with the drop today. I didn't end up taking profit, as many of you knew. I said if it hit 300, I'd definitely be taking a profit, but we're getting a bit of a breath, which I think is well deserved, which made me feel better because obviously I'm a long-term investor, but I recognize if it's an individual stock and I think the values are just too nutty, I would obviously start adjusting accordingly. But still, Tesla's the now largest position in my portfolio because of the absolutely absurd rallies that it has gone on, next to obviously the upper weighted tech companies in the S&P, because I have a huge amount of money in the S&P 500, about 161,000 converted to Canadian dollars. And if you just take a look here, that's why Apple and Microsoft make up the two next largest positions, probably equating to about just over 7.5%, something like that combined. Because I have, again, over 10,000 in cash now, cash makes up about 3.5%, being the fourth largest weighted position. I did not do the combined portfolio of mine and my fiance's together. I think that would be giving a little bit more of an accurate depiction. This is just from my personal portfolio. Again, it excludes anything else that we own: real estate, crypto, gold, precious metals, that stuff. So this is just purely equities, stocks in and of themselves. Nvidia's at 3.4%, no surprise. Amazon at 2%, Meta at 1.3%. You got Google in here at 1.3%, the two Google ANC shares in there. And then you got Home Depot, which is interesting because if we went a little lower, we should be seeing companies like Berkshire Hathaway. But because SCHD overlaps a lot of these stocks with the S&P 500, it'll upperweight them, right? So we see Home Depot is actually one of my largest weighted top 10 positions, which is really interesting. You got AbbVie, you're starting to see the SCHD influence here with Cisco, and you got Amgen, Chevron, Lockheed, BlackRock, and then you got Verizon in here. You got Coca-Cola, United Parcel. There's Berkshire Hathaway. So the overlap actually makes all those positions bigger than the lower half of the S&P top 10 companies: Eli Lilly, JP Morgan. Then you start getting into some of the Canadian stocks. Here we're going to see Toronto Dominion Bank, Royal Bank. Really interesting that now we see VDY's influence, because VDY, again, very concentrated in these stocks with 15% in Royal Bank. So I can put a lot less in here and get a lot more exposure to these bigger banks, which is exactly what I want. I told you guys, I like the concentrated exposure I get to these top weightings in VDY. But when we take a look at the sector exposure, this is where things get interesting, right? Because I feel like these dividend-oriented ETFs actually give me better diversity. I don't like having the kind of exposure that the S&P gives me to, let's say, information and technology at 30.6% is going to cause a lot of volatility, right? And I still want some excelled performance, which is why I pick individual stocks like Tesla to try and make up for that. And obviously Tesla, I guess you could say, is a tech company, but in the sector as it's listed is more in consumer discretionary, because I guess it's considered more of an auto company. They're making consumer discretionary products, but still, I love the sector weighting in this very moment. We got 19.4% technology. Muy bien. It should be the biggest exposure I have, but it's a very healthy exposure. You got, consumer discretion at second place, then you've got financials, then you got healthcare, you got industrials, you've got consumer staples, energy, we've got communication services. The only thing that I wish is that utilities were a bit bigger. I feel like I could have a little bit more utility exposure. Maybe I'll find a way to adjust that in the future just to start really equaling out my sector exposure. But because of this, I get a lot less volatility in my portfolio, which is shocking for a guy that owns Tesla and it's almost 10% of the portfolio. These, I love these dividend stocks and what they've done for me. Now, keep in mind, my spreadsheet only updates once every 24 hours. We were 5K away from that 300K mark, but we're going to see a correction here. We almost had 50,000. Well, we had more than 50K in gains. It's just that I took profit on Google, some other companies over the year here, so it's not adjusted correctly. But ideally, as time goes on and in a market cycle like this, I'm going to continue to allocate money and keep investing, but I'll probably keep putting it in these stocks that are starting to perform against the backdrop of the S&P dropping, because technology is just tanking today. Now, if the S&P drops by 10% or more, I will easily go back into these technology companies. I'll keep buying the S&P, but we're not in a big enough of a correctional period for me to feel comfortable continuing to just overload, right? I mean, a 1% drop after this absurd rally. Look at the 6-month rally we've had here. I like this drop here. We went really aggressive here, and that's what I want to see. I want to see another really nice, maybe a month or two of a pullback period. We'll see if we get it, but at this point, I'll pass the question off to you. I'd love to know what you guys think in that comment section below.